And now we have two more sessions here in this hall before we adjourn for the Digital Finance Summit. In Cancun, startups continue pitching. Here in the main hall, Paulo Cirone, a well-known fintech and digital banking expert, is delivering a highly expected keynote now. Concurrently, a country stage, then afterwards, Liudas Kanapiedis of the Compliance Solution, leader of Ondato, will take the stage to answer questions from Richie Santos Diaz once again. Thank you very much. Welcome, and the stage is yours.
Thank you very much.
Paola.
I'm very excited to be here with all of you. Now, my name is Paolo Cironi. In my business life, I'm the global research leader for banking and financial markets at IBM, the Institute for Business Value, which is the thought leadership center of IBM. And I'm also author of literature. And today I have the pleasure of sharing with you content of my latest Amazon bestseller, Banks and Fintech on Platform Economies. Right after this keynote, you can join me for a book signing. The books are free, so complimentary gift by the event organizer, and I thank them for this opportunity. So we are spending like half an hour together, but it's going to be like a little show, so I hope you will enjoy it. Does this work? Now, first of all, I want to clarify a bit what I do as a job so that we start framing the content of the presentation. You might see me around on social traveling continuously because I have clients everywhere in the world. And I think we can divide the world into three macro areas without forgetting anyone. In the United States of America, where digital technology was born 15, 20 years ago, so to say, and I know that countries like China are becoming very competitive, but if you go back in time, that's where it all starts. Europe. This is where the regulation typically is born, and in particular in the European Union, because the Commission has an interest to create the Capital Market Union to protect the investor, and regulation is always important in banking. But if you think about where are the biggest winners of the fintech revolution, they typically live and breathe in Asia Pacific, in places like China or India, because there the business models are born. So here is what I'm doing with you. We try to understand these business models, knowing that what works in Guangdong, China, may not work necessarily in Istanbul. We try to understand how technology can scale these business models. AI was basically like this some years ago. It jumped up with generative AI in the last year and a half. So we need to understand the maturity of technology. But then I want to keep everything within a regulated framework because this is banking and it's not just the Far West. So it's important that you understand how you change the business model and apply technology within a regulated environment. Having said that, we have 4 chapters to share today. There will be some content, I anticipate to you, but we reiterated the concept 2-3 times to make sure that we get to the point. First of all, we'll discuss business models, what it means. Second, we look at the banking reinvention quadrant, which is at the core of banks and fintech on platform economy. So we try to draw the future of financial services, understanding why what we see today is not yet the picture. And then I want to share with you some fintech lessons learned to understand key concepts. And we conclude with a personal story to explain what it means to build a mindset shift. So let's deep dive into the first chapter, the one of business models. Now, I don't know what you had this morning for breakfast, but I am Italian, my accent betrays me, and I'm supposed to have a cappuccino. And instead, I had an orange juice, because since 2008, when Lehman Brothers defaulted, I've been having an orange juice of freshly squeezed margins. Now, if you go back in time to remember what happened, it happened that the financial system started collapsing. So central banks around the world started lowering interest rates to save the market and the economy. And in places like in Europe or in Japan, they became negative. At the same time, the regulators increased the cost of capital, forcing the banks to de-risk from their credit portfolios. The consequence is that after the price for credit risk, there's no value anymore for the shareholders of most financial institutions, which forced a lot of banks to reconsider the centrality of the interest rate margins or the lending operations, looking at other places for profitability. One is payment, but if you look at China in particular, it's few basis points per transaction, not like a Stripe, which is 100 basis points in the US. And wealth management, but there is also competition, the commoditization of the financial products. You can think about the exchange-traded funds. So all in all, what happens is that the profitability of many financial institutions has been challenged by a complete transformation of the macroeconomic conditions. So the problem does not come from outside, the fintech, the narrative, the big tech. The problem is inside the industry, because the existing economic model does not correspond anymore to most of the prevailing macroeconomic conditions. Now, I will make some references to the European situation. I know that Turkey is kind of different, higher interest rate, much higher inflation, but if you like, the European Union is the weakest banking system in the world, paired by Japan. So that all of the weaknesses are exposed, and therefore the solutions can be identified. So if you bear with me, you will see why this is important also for places like Turkey. But then, I don't want to be the only one saying that the macroeconomic conditions are making the life of bankers kind of miserable. I want to blame people with bigger shoulders, and one of these people is Mario Draghi. Mario Draghi was a former central banker, the chairman of the European Central Bank, so he has big shoulders for this opinion. And in 2019, 2 weeks before he left office, a journalist asked him if negative interest rates, now you read it, complex macroeconomic conditions, because today the environment is not a return to the past, will create the next collapse of the financial system. So I want you to listen carefully to how Mario Draghi responds to this question.
Banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying that negative rates will cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
Now, 2 things are important about the video clip. The first one, Mario Draghi has a better English accent than mine, and that's given, he's a central banker. But the second, when central bankers talk, every word matters. He didn't say that banks have to digitalize existing business models, like lifting and shifting, putting them on cloud, and everything works. Not at all. The focus is on the business model. Banks have to change the business model to get the benefit of the digitalization of financial services. So then the key question is, what are these business models? A little bit of a suspense, but we're going to explain that because that's inside banks and fintech on platform economies. So what we said that in the first chapter is that what matters is to understand how to modify the business model so that you can effectively engage clients on digital in a way that you can also generate revenue for yourself by building value for a client. Because the problem of most of the fintech or the neobanks is that they are on digital, but they're not making ends meet the way they should do, because the business model is not yet correct. So now, to understand this, we deep dive into the banking invention quadrant. Now, there is an interesting paper still by researchers of the European Central Bank that says that financial institutions exert market power, so the fintech, if they have superior information and communication. So we need to understand what is information and what is communication. Now think about the 2 key pillars of a bank, the core banking, where you have a lot of data, information about client payment transactions, and the interface, which are the branches or the discussion in front of the client. Now, the European Central Bank is saying that given the conditions in the marketplace, which still persist with the growth of interest rate that might create a further credit crunch as effectively businesses are hit, the role of information, that means core banking data, is not enough anymore to remunerate shareholders. That means if banks keep the core banking closed, they cannot make money as they did in the past. So what is the solution? They say, well, they need to open the core banking infrastructure to intersect via banking as a service type of architecture with the fintech ecosystem. So that means allow the information you have in core banking, which is payment transactions, the adverse selection for doing credit, to be used by other people, fintech, big tech, so that new businesses or business models can be created to generate value for the consumers. It's an element of contextualization outside of the banking border. But the ECB researchers also say that there is evidence that communication is becoming more and more important to define the core profitability worldwide of financial institutions. And the problem with communication is that that typically uses human interfaces, me talking to you, which are not so easy to be digitalized. So the core element here is to learn how the fintech ecosystem, through a banking as a platform, can add value to the interface of banks. So now we go back into the banking relationship to help banks justify the value in front of the clients. So basically, the ECB says information and communication. Information is data that needs to go out of the bank through a banking as a service to enrich the ecosystem. But at the same time, the ecosystem will bring innovation into the bank, flip a coin, a banking as a platform to enrich the banking relationship with non-banking solutions to make it more relevant. Now, what I did in these banks and fintech and platform economies is that I took information and communication and I made it the axis of the banking invention quadrant. Now, don't get agitated. I know that when you see a graph, you get concerned. It's very conceptual, and we're going to reiterate a couple of times the concepts. Now, the banking innovation quadrant is a space that basically corresponds to the capability of institutions to generate business value. The vertical axis is information that goes from products into platforms, so opening up to ecosystem interaction. And the horizontal axis is communication, from traditional distribution of products through data-driven distribution into transparent intelligence. We're going to define in a moment what it means. Now, the top right corner is the higher business value, where every institution, every fintech might want to be. But where is banking and where is the fintech ecosystem today? Well, I would say that it occupies the lower left side of this corner that is made of traditional banks, let's say branch-based banks, and also digital banks can be neobanks that you've been seeing popping up very recently quite a lot. So now, why they don't occupy the full space? Well, already some years ago, Accenture said that $1 trillion were spent, and now that figure is like a multiple, in digital transformations, but primarily chrysalises were born and not butterflies. I thank them for the problem. I want to tell you, how do you become a butterfly? Understanding how to slide on the information quotient and the communication quotient. So basically, sliding on the information quotient is like moving from output to outcome, a concept that we reiterate. What it means is like Amazon. Output is products, transactions. Outcome is like you pay for your journey. It's like an Amazon Prime, right? So you're there on the platform and you pay for access in the platform. So there is a shift in the way people have to pay out of products into journeys. That's why it's important to interact with the fintech ecosystem, to embed yourself into a journey that is more meaningful for a client. And this axis, you will see in a moment, is more a technology axis. What we've been seeing in the last years a lot and have been discussed and debated, data and cloud. Sliding on the communication quotient instead means understanding the difference between push and pull, a concept that we'll explain in a moment with a very nice video that I want you to watch. What it means that many fintech and banks made a mistake. What is this mistake? You see this iPhone, could be your Samsung. That's mobile technology. Mobile technology is a technology of the demand. That means that people are capable of pulling data, pulling products by themselves. Ask you about Amazon. You don't go on Amazon to see what happens. You go there because you want to buy one of my books, and then you buy another one. You don't have to buy it. It's free later on. But basically, you already know what you want. It's demand-driven in many cases. But when it comes to financial services, the revenues that matter, I explained before, they operate in an offer-oriented ecosystem. So banks are pushing to the client. So the question that you need to answer is, how do you put an offer-driven industry onto a demand-oriented technology? If you don't resolve this puzzle, you can have a nice fintech, a nice digital bank. You will not generate value, and we'll get there in a moment in the course of this presentation. So now, as I just mentioned, the sliding on the axis enables you to reach out to these two spaces, which I define contextual banking platform strategies. That means the bank is invisible, gets embedded, like embedded finance, into another journey. And conscious banking, that means banks will stay. Not Jeff Bezos, Bill Gates was wrong. He said that people need banking and not banks. True, but they need bankers, a relationship, and we see why this is so. So that is a different type of platform strategy, which is called conscious banking. The bank is now transparent, visible in front of the client, needs to demonstrate value. So now, intensifying the information quotient means investing in cloud, in data, and we've been seeing this a lot in the last 10 years. But what we haven't seen so much is understanding how to digitalize communication, the relationships. But guess what? This is the age of generative AI, right? And what generative AI is famous for is large language models, so machines talking to people. So now you see there will be more capabilities to move also on the right through the communication capabilities of artificial intelligence. Now, let's figure out and explain a bit what these two platform strategies are that identify the business models that Mario Draghi was thinking of. So we are talking platforms here. Okay, we see that the shift is about platforms. And what platforms are good at is eliminating friction. So we need to identify what is the friction that contextual banking strategies eliminate, and what is the friction that conscious banking strategies eliminate. So now, contextual banking definition. I'm speaking like Mario Draghi here. Every word matters. It is the opportunity to eliminate ecosystem friction. For example, if you will not be able to pay with one click on Amazon, you will not buy anything on Amazon. They want to go to the post office, right? If you will not be able to get the money back as soon as you realize the product is not good and you ship it back, you might not trust the fact you can buy the product that looks good to you, but maybe it's not so. You can get it, and the money is back to you in a moment if you don't like it. So now it is the opportunity to eliminate ecosystem friction that makes banking contextualized, so inserted in another journey. That means embedded to unlock new value. Again, the evil is in details. Unlocking new value means that the value is not in the transaction. It starts from the transaction, but at some point, those transactions commoditize. So the value needs to be defined somewhere else, owning, for example, the ecosystem engagement. I'll give you two little example of one that matters to you. As IBM, we helped Bradesco in Brazil last year to launch an agri-farm platform that wants to interact with 50% of the GDP of the Brazilian economy because farmers do the work on food. Basically, it's a solution that enables them to allow the farmers to do their job. It's about their job. And then at the same time, they can service themselves through the platform and having financial services like looking at the loans, the leasing, and so on and so forth. Or State Bank of India, the largest bank in India, 600 million customers, work with IBM to launch You Only Need One, that now is evaluated more than the bank. You Only Need One is a marketplace, like Amazon. For some products, sells more than Amazon in India, but has a digital wallet at core that banks people on the banking relationship and then uses it as people go through their journey to position insurance contracts or wealth management products. So two examples of contextualization into different journeys, an agri-farm platform and a marketplace for consumption. And what is conscious banking? Well, conscious banking is slightly different. It is now the need to demonstrate value for clients because clients will have to pay for those services more and more so. Therefore, you need to eliminate the knowledge friction. Don't forget, people don't understand financial services easily, so they relate to bankers for a conversation to make important decisions. It is this need to demonstrate value for clients that makes banking conscious. That means transparent. You need to demonstrate that value to get the trust. And that unlocks hidden value. Value which is part of the banking relationship, but is forgotten because bankers don't operate like advisors that much, but as like a distributor of financial services where these products are commoditizing more and more so, and therefore the margins and the revenue are shrinking. So now, what did we say so far is that first, it is not enough to lift and shift the business model on cloud to transform financial services. The core element is to adjust the business model to get the benefit of the investments of the digitalization of financial services. And what are these business models? Well, on the banking innovation quadrant, we identified that there are two emerging strategies that are a collection of models. One is called contextual banking. That means inserting yourself through open data, open banking, open finance into somebody else's journey to be relevant there, eliminating the friction of that ecosystem. If you didn't get that pay with one click, Amazon would not work today. But is Amazon paying back the banks for the value they get? Maybe not so. They had to think about it first, the bankers they joined in. And the other one is conscious banking platform strategies. Branches will stay. They will be smaller network than in the past, but relationships are important. So bankers now need to ask clients to pay for that conversation, the banking relationship. And therefore, they need to use technology because that's a different and difficult conversation that they need to have. So they need to systematize this on the network. And that's where now generative AI and AI is starting to kick in to help the bankers to do their job better and at a bigger scale, given the fact that human relationships are expensive and tiring, right? So they need to be supported. So now, thinking about all of this, a couple of fintech lessons learned that are important to reframe this concept into your real life and experience. So we try to slide on the information and the communication axis. Now, to do that, I want to share with you this little clip. I don't know if you know South Park. I believe so. This clip was on American television in 2009 after the default of Lehman Brothers and the loss of reputation of banks. And the little kid has some money to invest. He goes to his bank, and I want you to see carefully what happens. This.
I got $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm
my...
sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
Okay, so don't worry. These things don't happen in Istanbul, only in London, and they're not even part of the EU, so it's okay, right? You're protected. Now, there could be some considerations also in the conversation and the behavior of the banker, but what matters for me in this clip is that the little kid is the majority of customers out there. They don't understand finance. There are some reasons for that I discuss here anthropologically. But that means they are exposed to the conversation of the bank, where then the bank pushes the product. Now, let's assume there's not fear of missing out. If you don't get the NVIDIA stock, you will not be rich. If you don't get the Bitcoin, you will not be rich. If you don't get the confetti on your screen, you will not be rich, right? So that's not part of the framework. But in this asymmetrical element, where people don't understand, they look for a conversation, and through that conversation, the banks operate as an offer mechanism. The marketing retail pushes product. And that's difficult in digital. That's why a lot of neobanks don't know how to operate, because they don't understand how to push products on clients. They just put products on display, people see them, but they don't buy them. Now, that tells you, if you understand it clearly, the story of the fintech innovation the last 15 years. Let's say that we can go from a demand-driven business model into an offer-driven or offer-oriented business model. In between, you have the pull and push. Okay, pull, you demand, you know what you want, push, it has to be pushed to you, otherwise you don't get it. And in a sense, it starts with more contextualization as opportunity, and then it leads into more conscious banking, so transparent banking as a platform, as you move up into the asymmetry of information. Now, the asymmetry of information means that people don't know, don't understand. And get me right here, I opened all of the BlackRock conferences in the world in 2019 and explained to their clients trillions of AUM. What the problem is, this is an industry where very few people pretend to know much more about the future, and they know nothing about it. And the majority of people believe they don't know anything about the future, but they know enough to be sober and cautious, okay? So matching this properly generates value. Matching this improperly, securitization, does not generate value, but destroys it. So now let's start with the demand-driven. There are 4 business units in a bank: payment, credit, investment, and insurance. So payment is very demand-driven because, you know, you just get one click, the convenience, and you go. Now, there's no surprise that the biggest unicorns in fintech are all in the pay tech. That's where they started, okay? Because they can scale up very fast. People understand the value. The next to payment is credit, which is still fairly, demand-driven because if I give you money for free, right, you like it. Now, let's think about it this way. If you go to my webpage, thepcironi.com, and you look at the first picture, which is the book on the first page that pops up, I will give you 10,000 Turkish lira, 0 interest rates, 0 commissions. You can give back to me the money whenever you want. Wouldn't you do that? I see some friends doing it, but I know your credit rating and I'd be concerned about what happens here. So risk manager kicks in. There is a surprise. Marcus of Goldman Sachs tried to use unsecured lending to onboard clients for a cheaper price than doing marketing, but it got into a risk management problem as the market changed faster than they thought, or they didn't even think that the market could have changed. Now they have to push Marcus out of the spotlight into a manager relationship to shield it, because the unsecured loans are mounting. The same can be buy now, pay later, and other elements. Don't forget, it's not enough to give money to people. Money needs to come back to you, right? So you need to be sustainable. But now this is, if you like, the pull side of the business, the demand, and the credit tech are also there growing more than any other company. It becomes a bit more complex when you move on the other side, when it is more offer-oriented, like investment management. It can be wealth for the retail, the affluent, or the private. I'll give you again this example. If you type in again thepistol.com, I know you're doing that, and you go to my second image on my page, you click on it, you will give me 100,000 Turkish lira that I will invest into a model portfolio made of 50% cryptocurrencies, 30% European stocks, 20% stocks from China, but not the Chinese companies in Guangdong because they pollute and I am ESG. Now, I'm sure that you're asking yourself, should I trust Paolo? Now, you don't know. I was quantitative risk manager for 15 years before funding my Fintech that was bought by IBM. So you can ask and check around with the organizers. I understand portfolio management. But there is a distance. And that distance needs to be compensated for you trusting me, knowing me. There are many elements by which you build that one. So therefore, it's very difficult to digitalize this one because not necessarily trust the app per se if they don't insert an element which cannot be good for regulators of fear of missing out that you should not consider. And what about the last one, insurance? Where insurance is the least industry in the game, the most complex to digitalize. Why? Well, that's because imagine that I want to sell to you life insurance. I need to tell you that you're going to die. You may not want to have this conversation with ChatGPT, would you? So that you understand that it's more complex because the amount of uncertainty that defines the information asymmetry is higher, and therefore the conversation is more important. So now, understanding this enables you to figure out in the various sections how you position an offer-oriented industry onto demand-driven technology. Otherwise, you don't crack the code. Now, let me tell you, let me blame somebody else. I was at Paris Fintech stage some years ago, and I asked Yves Perrier is the chairman of Amundi, the 10th largest asset manager in the world and the biggest one in Europe. And I asked him, Yves, so he's on the push side, what is the product or solution that justify the fees? Go.
And I think that the real value, which is brought either by banks or asset managers or life insurance companies, it's firstly a service of advice and permanent advice during the time of their investment.
Okay, yes, the value question is... You don't say my products. He said the communication, the advisor relationship. If you don't digitalize that one, you cannot operate. And that needs to happen on the platform economy because, you see, if you go back in time and you think about the internet revolution, LinkedIn is a winner because they became the platform of my business life. You can connect there. Facebook is another winner because they're the platform of my personal life. And then you can get Amazon, which is the platform where I try to sell my books. You don't need that because it's free if you join me after this speech. And Twitter used to be the platform for my Trump paranoia. Now it's the platform for my mask paranoia. It's a paranoia platform in any case. And WeChat in China is the platform of all platforms. So the question that you need to ask yourself, which dictates the future of financial services with the fintech is, where is the advisory platform for my financial and business life? And you will see, if you can spend more time, that this is starting to appear. So now we are towards the end of the presentation, really at the end. We said we need to adjust the business model, otherwise it doesn't work. This business model is to look at the platform economy, contextual banking, embedded finance, and conscious banking. transparent advisory. We understand that the asymmetry of information defines the capability to digitalize. Payment and credit, with the credit problem to be considered, are more demand-driven. Investment and insurance are more offer-driven. And now, to understand this, as we discussed the advisory platform, I conclude with a little story that is about my personal experience that I want to share with you, and the one of Jeff Bezos. I like to associate myself with big people. Now, before I started my career in banking as head of quantitative risk management, I helped my brother in Italy to build the Amazon of Italy. Don't laugh. I see you're laughing, okay? Look, I had the best products on earth. Think about it. Fashion, food, furniture, and even travel. I thought, I just put my products on the internet and I will get rich. Everybody will want them. I sold nothing, zero. I had a sleek web design, very nice, and I thank my brother for the dedication. He's older than me, but we really didn't go anyway. We sold nothing. And we made many mistakes, but there's one that I learned years after when I listened to a Jeff Bezos interview on 60 Minutes. Basically, the interviewers, the journalists, asked Jeff Bezos, what's Amazon? And Jeff said, with his spirited eyes, Amazon is not a distributor of books on the internet. Now, you are my age, you remember they were only selling books at the very beginning. You're much younger, you don't know that, and now they sell a lot, but they were only books. And I'm like, what do you mean Amazon is not a distributor of books on the internet? That's what they do. And he said, let me explain why this is not so. He said, the publishers are sending me letters these days, and they complain saying that I don't understand marketing. Now, call Jeff Bezos stupid. He said, the reason is because they say that I should not put positive and negative reviews of books, but only positive reviews, so they can sell more. Now, that needs to be framed in a regulatory framework, because that can be also abused, and you know that. That's why regulation is important. But the point is that he said, you see, they don't get that. I'm not a distributor of their books on the internet. My role is to advise people on which is the best book to buy. And to do that, I use positive and negative reviews as an element of transparency to build trust so that they don't touch the book. They cannot smell the glue, which we'll do in a moment, and therefore they trust me to buy it. Okay, so that is said, I am an advisory, of their clients that enables them not just to be on Amazon, but to act. Otherwise, you have a lot of clients there, but they don't transact and you don't make money. Now, this is very important, and I wanted to share with you because when he concluded the interview, I almost had a heart attack because he said, only after I resolve the motivational problem, the pull and push, you know what I do? He said, I use data and analytics, today would say generative AI, to understand the client and to move him around on the platform. So now, why does this matter to conclude? It matters because I think that many had the wrong perspective. I know that you've been hearing a lot, maybe at this conference, about the data-driven banking or data-driven insurance. In reality, you've been seeing the picture upside down. Data enabling clients so that they are enabled to make decisions of your platform precedes data-driven banking. If you believe that AI is there for you to understand the client and use it as a bazooka for marketing, pushing products to people, and those people are not enabled, you will basically go nowhere. So now I thank you for the time you dedicated. We said many things. We talked about business model adjustments. We talked about strategies, contextualization, and conscious strategies. We talked about information asymmetries, and we concluded with an explanation of what it means to be an advisory platform using an example that may be under your eyes, but I guess you never thought about it. We wrap it up with a little reel for 60 seconds, and then we say, meet me at the book signing. Ready? Hey, that goes very fast, you know?
One last video.
Thank you very much. Okay. I hope to see you all. It's free, so
Thank you
want
very
one.
much.
Thank you.
Thank you, Mr. Paula, for your kind contributions.